Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and here is a look at the stories for the day. Zee Entertainment and Sony Pictures have finalized their merger after 90 days of negotiations. This deal is expected to change the country's entertainment landscape. The pact is seen as complementary to both the groups, but more importantly, it allows Zee founder Subhash Chandra to retain his family's hold over the company. Let us see how the future will unfold for the Chandra family as they still address investors' concerns over corporate governance issues.
The merger of Zee Entertainment Enterprises and Sony Pictures Networks India creates India's second largest entertainment network that will take on Star India, owned by the Walt Disney Company. The Sony Zee alliance will include over 75 channels, 2 streaming platforms, and command a 28% share of Indian TV viewership, putting it firmly ahead of leader Star India. Soon after announcing the pact, Puneet Goenka, the CEO and Managing Director of Zee Entertainment Enterprises, told Business Standard in an interview that it was his job to take the best of both the firms. Goenka, the son of Zee founder Subhash Chandra, has been told to lead the merged entity. The deal comes in the middle of a face-off between Chandra's family and Zee's largest shareholder Invesco that has now reached the court. The US investment group, which holds an 18% stake, is seeking the ouster of Zee CEO Goenka. Sony will hold a 50.88% stake in the merged company and the Chandra family 3.99%. Zee's public shareholders, including Invesco, will own the rest. Zee's founding family has agreed to cap the equity they may own in the combined company to 20%. Analysts believe that the merger addresses concerns on governance, with Sony appointing a majority of directors to the board and the Chandra family not getting preferential rights on stake increase. We spoke to Business Standard's Vanita Kohli Khandekar to understand the implications of the deal.
The Sony Zee deal is according to me a great fit between the two companies, and it is also a win-win for Puneet because he's built this company from 2006. He's taken this company from around 1,900 odd crores to almost 8,000 crore today. So he's built the company, he's rejuvenated Zee. It was down and out when he joined, and he knows the company very well and he knows what to do to take it to the next level. More important, I think getting Zee in the fold brings in a strategic international investor who understands a global media company. So it internationalizes Zee in a very nice way. So the competition between Sony Zee and Disney Star, remember that Star became a part of Disney 2 years back. So both are now 14,000 crore companies, and Sony Zee will be the second largest media company after Disney Star. So the competition will now be among equals. So it will be a fun game to watch. And I think, from the Chandra family's perspective, also they still have some skin in the big media game. So it will be good fun to watch.
In February, Invesco had facilitated merger talks between Zee and Reliance Industries, which owns the listed Network 18 Media and Investments. But the talks fell through. Goenka has now managed to win Sony's confidence to lead the merged entity, despite Invesco's bid to force him out. Chandra is also strengthening his commitment to Zee by infusing the non-compete fee of about 1,100 crore rupees arising out of the deal terms into the merged entity. Sony India will transform from a private to a listed company after the merger, and to deal with the public scrutiny that comes with it, Sony is banking on Goenka, who has led Zee since 2008. He has continued firmly in the driver's seat even as his family's stake fell from 35% in 2019 to nearly 4% now. Banks had invoked pledged Zee shares to recover dues owed by Chandra's SL Group companies. The merger will also ensure a more robust management supervision that can alleviate investor concerns. To find out the significance of the Sony Zee deal for Zee founder and SL Group chairman Subhash Chandra, we spoke to Business Standard's Pranjal Sharma, who is also the co-author of Chandra's autobiography.
It's important to understand something about Dr. Subhash Chandra. Dr. Subhash Chandra is a pioneering entrepreneur in many ways. While we know him largely because of the broadcast sector, we must remember that he was a pioneer even in the amusement park industry. He was the first to set up a large-scale amusement park in India. He was a pioneer in the packaging industry by bringing the latest technology in packaging for products like toothpaste, etc., into India. And of course, single-handedly created the private broadcast sector in India. And not to mention the fact that at one point he had also launched the Indian Cricket League much before the current IPL. To my mind, the current situation with Zee-Sony is important because Zee has been a flagship group. It defines the entire group, and it's absolutely close to the family and to Dr. Subhash Chandra himself. So I think in this new form as well, the important thing for the family and for everybody concerned is that Zee remains part of the group, that Zee in its entire network, its expanded networks, remains part of the family, and the family remains involved in it. And the vision that Dr. Subhash Chandra has had about the broadcast sector in India perhaps is reaching a new milestone and could be articulated through new joint ventures in the coming years. Remember, even in the beginning, when the Zee group was launched, there was partnership with various other companies. Rupert Murdoch had been a part of it in some way. Before that, Lee Ka-shing had been part of the origin of Zee. So it's not as if the Zee group has not had foreign partners. It has always had various partners at different points of its time. So I think from that perspective, the Zee saga and the Zee journey continues in the new avatar.
The Bombay High Court is hearing Invesco's appeal against an order that barred it from calling an EGM of Zee's shareholders to oust Goenka. Zee's merger with Sony would still need the approval from 75% of Zee shareholders, and winning Invesco's confidence is crucial. With the uncertainty surrounding the merger over, experts believe that the merged entity holds a very promising future. By joining forces, the new company may well become the leading player in the entertainment industry. Zee's good market position and its experience due to being a listed company will only be an added advantage. Now, the ball is in the shareholders' court.
Soon after the news of merger came, the stock of Zee Entertainment soared 2.58% before taking a plunge. Now it settled a tad below its previous close. Half of the companies listed in the past 2 months are trading below their issue prices now. These include the likes of RateGain Travel and Technologies, Star Health and Allied Insurance, Paytm, and Policy Bazaar. Besides, recently listed companies, especially from the digital space, have tumbled nearly 50% from their recent highs. Yet, market watchers don't see them as value buys just yet.
The recent bout of profit booking has eased concerns surrounding valuations in the market. At the headline level, the benchmarks have corrected nearly 10% from their record high levels, while individual stocks have tumbled nearly 50% from recent peaks. Among these, shares of recently listed companies, especially from the digital space, have been the worst hit. FSN E-Commerce Ventures, Nykaa, PB Fintech, the parent company of Policy Bazaar, Tega Industries, Tarson's Products, Aditya Birla Sun Life AMC, SJS Enterprises, Indigo Paints, Anand Rathi Wealth, and Glenmark Life Sciences hit their respective lows since listing on December 20. Further, 50% of the companies listed in the past 2 months are trading below their issue price, including RateGain Travel and Technologies, Star Health and Allied Insurance, Paytm, and Policy Bazaar. And analysts say the worst may not be over for some of them yet. G. Chokkalingam, founder and chief investment officer at Economics Research, for instance, suggests investors should carefully analyze the business prospects of each of these companies before taking an investment decision.
I would not suggest retail investors rushing to buy the e-commerce companies which are listed recently. I want to make a very interesting, important insight. You have venture fund investing in equities. Normally, they are rewarded only the full cycle of venture fund is completed, which means they take a maximum risk in investing in new ventures, and only when the ventures become highly successful in terms of bottom line, they ultimately unlock gains from that. So what I observe here, most of the e-commerce companies listed, they are loss-making and substantially loss-making. Even some of them have not improved the top line also. So what I'm trying to tell you is that the venture capital cycle is not yet complete, but they rush to the market to list them at a substantial premium. And in the process, many retail investors are converted into a venture capitalist. And whereas most retail investors do not have adequate knowledge to evaluate. So therefore, one should avoid them. And unless you are confident of, with help of any research analyst, that within 2-3 years they turn around, will make a substantial profit to justify current valuation, you should not get into that. So which means 7 out of 10 are avoidable. One should not take a risk just because they have corrected. I believe most of them can correct at least another 20-30% from the current levels.
Gaurav Garg, head of research at Capital Via, echoes a similar sentiment and says that the current market sentiments have put almost all the IPOs on back foot, and we have seen muted listings on most of them. I think in the current market situation, most of the blue chip companies with strong balance sheets are available at decent valuations. Investors should look at buying them and can wait for a few quarters more to see the performance of recently listed companies. The so-called hurried decision to hit the market by new age companies followed a strong bull run and a gush of liquidity in the markets. According to an analysis by Kotak Mahindra Capital Company, the year 2021 saw the highest ever IPO volumes in the country, with the volume surging to $15.3 billion as against $4.2 billion in 2020. That means the streets saw more IPOs in 2021 than in the past 3 years combined, both in the numbers of listing and the amount raised. However, despite the current volatility and steps by central bank to escalate the process of liquidity withdrawal, the IPO frenzy is set to continue next year. According to Kotak Mahindra Capital's estimate, $26 billion worth of issues are in the pipeline from resilient sectors such as new age tech, healthcare, consumer, realty, and specialty chemicals issues. While IPOs worth $15 billion have already been filed with the SEBI, issues worth $11 billion are likely to be filed near term by several high-quality companies across large caps and mid caps. That said, V. Jayashankar, whole-time director at the brokerage, had this to say. While 2021 was huge for IPOs, we expect 2022 to be another good year. Nevertheless, investors should be cautious and not assume all IPOs to hit the bullseye. On Wednesday, Metro Brands joined the bandwagon of companies staging weak debut as the shares listed at a 13% discount in a firm market. Against this backdrop, shares of newly listed companies will be on investor radar. That apart, stock-specific news flow, weekly F&O expiry, and general global trends will guide the markets.
Just like the IPOs, investors should also tread with caution while purchasing cryptocurrencies. Now, if global investors are to be believed, India emerged as the fastest growing crypto market in the world this year. The sudden rush of huge money and RBI's tough stance against the digital currency have put the government in a fix. Now, a bill to regulate it remained a work in progress, even as the winter session of Parliament was adjourned sine die yesterday. So, what is puzzling the government? And overall, how was the year 2021 for cryptos? Let's understand.
Another year has gone by without India getting a firm hold over how to regulate cryptocurrencies. The divide between the government and the Reserve Bank of India remains. The RBI is concerned that cryptocurrencies pose financial risks to the country's macroeconomic stability. The government, however, is reportedly looking at a more accommodative approach, rather than a ban on all private cryptocurrencies. We don't know yet what's inside the proposed bill to regulate cryptocurrencies. But Indian crypto exchanges have revealed the questions they are being asked by the government. Broadly, the conversation over how to regulate crypto is around these queries. Which is the best authority to regulate crypto? SEBI, RBI, or even the International Financial Services Authority in Gujarat's Gift City? What are crypto assets? How can crypto exchanges, both domestic and foreign, be registered in India? How to tax crypto transactions? How will exchanges be allowed to list new cryptocurrencies? Do cross-border cryptocurrency transactions violate Foreign Exchange Management Act rules? Several solutions have been proposed. Under the FEMA Act, the Liberalized Remittance Scheme or LRS allows for outward remittance worth $250,000 per Indian per year. However, there is the concern that since cryptocurrencies help users transact anonymously, it would be impossible for the government to check the quantum of inter-country cash flows. This could cause disturbance in the country's current account deficit and forex reserves. For this, Policy 4.0, a crypto and blockchain focused think tank, has proposed the India Wallet. This will be a KYC compliant wallet that will have to be integrated by all domestic and foreign crypto exchanges to offer trading services to Indian users. It would help regulators distinguish between domestic and cross-border transactions. Balaji Srinivasan, angel investor and former CTO at Coinbase, suggests that India treat crypto as foreign assets under its FEMA rules. RBI could use FEMA to regulate crypto exchanges as authorized persons per the Act, thereby permitting them to deal in foreign currency. Most developed countries, including Australia, Canada, Japan, South Korea, the EU, and the US, have brought crypto asset business activity within the anti-money laundering regimes. Such an approach has also been recommended by the Financial Action Task Force. Now, despite the regulatory uncertainty, crypto has flourished in India, with more and more users turning to these new age investment instruments. Even before trying their hand at the stock market, there are 15 to 20 million crypto investors in India, with total crypto holdings worth $5.33 billion US. Indian crypto exchanges such as WazirX at 10 million and CoinSwitch Kuber at 11 million have more registered users than Zerodha, the country's largest stockbroker, at around 7 million. We reached out to crypto exchange ZepPay to understand how, despite the regulatory uncertainty, the Indian crypto ecosystem has matured this year.
Even if after like recent price drop, last 1 year the Bitcoin price has gone up by 70%. And this time last year we were at around $30,000, $29,000 in terms of Bitcoin price. Institutional investors have come, which is I think have gained momentum in 2021. What we are discussing with the government and the news which we are getting or indications which we are getting is that government is also looking at in terms of regulating crypto in a way which ensures that we are able to harness the positive potential, at the same time limit the scope for any negative or unwarranted use case. Maybe there is a case for some independent agency which basically takes experience and people from both RBI and SEBI, because crypto is still an evolving kind of technology. Okay, so the way you had in, let's say, telecom, TRAI was instituted. So that, in our view, may be the preferred approach. But at the end of the day, whether it's SEBI, RBI, or Gift City, I think at least it will be the first step in the right direction.
It is important to realize that the conversation over crypto regulation isn't limited to cryptocurrency. There's an ecosystem of non-fungible tokens, metaverse, and Web 3.0 that is leveraging blockchain technology and crypto as a mode of payment. If the Indian government takes any decision on crypto regulation, it will have to factor in these newer use cases of blockchain and crypto as well.
Even as it maintained a tough stance against cryptocurrencies, the Reserve Bank of India ushered in several reforms across sectors this year. Among them was changing the norms for securitization of assets like loans. The minimum holding period before an asset is securitized was reduced from 12 months to 6 months. Now, this is expected to boost volumes in the space. But what exactly is securitization? Here is an explainer for you.
Let us assume that a property loan company wants to raise funds. Under normal circumstances, it would take a loan from a bank or sell bonds to investors. The interest rate on the bonds depends on the company credit rating and other financial parameters. The company can also sell some of its loans directly to willing buyers, thereby converting a future income source into cash today. However, it may be harder for the buyer of such loans to trade it again in the secondary market. But the lender can raise money by pooling these property loans and selling it as a package to a special purpose vehicle, which in turn converts this pool of loans into tradable securities that are sold to investors. This is known as securitization. It is the process of taking often illiquid financial assets and converting them into liquid marketable securities for the purpose of raising funds. Any type of asset with steady cash flows can be securitized, such as housing loans, gold loans, vehicle loans, personal loans, education loans, and even credit card receivables and trade receivables. Generally speaking, the securitization process involves three main entities: the original lender, a special purpose vehicle, and the investors. Let us understand more about these three entities. The originator or the original lender is the bank or an NBFC that has loaned the money to borrowers. These loans sit on its books as assets. The assets of the financial institutions are then securitized by an issuer, such as a special purpose vehicle or SPV in short. The SPV converts the pooled assets into tradable interest-bearing securities. The SPVs can be a company or a trust. Companies like Axis Trustee Services or IDBI Trusteeship Services provide trusteeship services to such special purpose vehicles in India. In the final step, these instruments are sold to investors who will be receiving fixed or floating rate payments. The payments are funded by the expected cash flows from the underlying portfolio. Usually, the originator collects the payments from borrowers and passes them on to the SPV, which then distributes it to investors. Securitization allows the original lender to remove the associated assets from its balance sheet, thus freeing up its capital for further lending. It is an alternate form for financial institutions to raise money. It also creates liquidity by letting small investors participate in instruments that would normally be unavailable to them. Most importantly, securitization enables the transfer of credit risk for the lenders.
The Reserve Bank of India has summed it up well in its notification. Prudentially structured securitization transaction can be an important facilitator in a well-functioning financial market as they improve risk distribution and liquidity of lenders in originating fresh loan exposures. Now that's all we have for you today. We will be back tomorrow with more news and analysis. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.